The opening range breakout strategy is one of the most popular trading strategies because it offers an easy trade setup every single day. Even though it's popular, there are common mistakes that traders make while trading the opening range breakout. In this video, I'll be sharing everything you need to know about the opening range breakout strategy step by step. I will also be sharing my favorite highest probability entry model as well as useful tips to help you increase your win rate. First things first, I'm going to go over why traders use this strategy. It is beginner friendly. You see that you can execute this strategy in 4 simple steps, and step number 4 is the most important because it's the make or break or whether you make money or not. But I will be showing you the high probability entry model that I use to execute this strategy. Number 2, it is based on one candle, so it's pretty straightforward. It shows up every day, and when the move happens, it is fast. So if you're right, you find out really quickly, and if you're wrong, you find out really quickly as well. This strategy works on the London session, New York session, and Tokyo session, which is also the Asia session. I have found that the New York session has the most liquidity and volume, and this strategy works best there. I could be biased, but I have tested it on the New York session and it works really well, especially with the entry model I'm going to be showing, so make sure you watch the video. For this example, I'm going to be using the New York session. So we wait for the New York session to open at 9:30 a.m. EST. And then that brings me to step 1. You want to wait for the first candle to form. Notice I said first candle because this strategy can be traded using the 30-minute opening range high and low, or the 15-minute opening range high and low, or the 5-minute opening range high and low. Depending on your personality and how you trade, you can use either one. If you're someone that is gentle or wants to see price action develop, you are waiting for news that comes out around 10 a.m. Eastern time, then you will most likely be like, okay, let me trade off the 30-minute opening range breakout. But the thing is, you could miss out on the move and the candle might be so wide that you've missed out the whole move for the day. You could also be like, oh, I want to trade the 15-minute because it's the happy medium between the 30-minute time frame and the 5-minute time frame. It's up to you. But for this example, I will be using the 5-minute time frame to illustrate how to trade it. Step number 2, you want to mark out the opening range high and low. So you wait for that candle to finish forming. The candle forms, you mark out the high and the low. It doesn't matter if you have the wick there, you mark it high and low. Once you've done that, you want to go to the 1-minute time frame and you wait for direction. In this case, the market broke to the upside. If it broke to the downside, you would also do the opposite of what I'm going to show you in this video. Once you've seen that, okay, it's broken to the upside, you don't want to chase this candle or chase this break because the market always or most times would tend to revisit the opening range high. So now we're going to now wait for an entry. What does that look like? Like I said, I'm going to show you 2 different entry models that you can use depending on market context, and I'll show you my favorite one. 2 different type of entries are either you wait for that retest and you enter once the retest is confirmed and then you enter the trade, or you wait for the retest to happen and then wait for extra confirmation and enter on the second breakout. I'm sure you can guess which one is my favorite. If you're watching this video at this point, put in the comment section which one you think is the best one. Okay, my favorite entry model is the retest one. Why? Because of risk to reward. That's the simple answer. I like to wait for the retest to come back to that level, like sellers to push price down into that level, but then buyers will step up and push price to close above the level. And then I wait for another candle to form to show that buyers are stepping up, and that candle must engulf the signal candle. So signal candle is candle 1. The second candle I'm waiting for, candle 2, is the one that I want to engulf or at least show me that buyers are stepping up there. And once the candle closes I then enter here, and I am looking for either a 1 to 1.5 risk to reward or 1 to 2 risk to reward. Because I know this strategy has a 60% win rate, or on a bad trading month around 50%, I know that if I target a 1 to 1.5 or 1 to 1.2 risk to reward, I will be profitable. So that's risking $100 to make at least 150, or risking $100 to make at least 200, depending on your risk. So that's my favorite entry model that I have seen work well and has the highest probability of the trade working out in your favor, and you know that your stop loss is just one candle away and your profit target is either 1 to 1.5 or 2R, depending on depending on the market context, obviously. Now, I'm not going to end this video without giving you useful tips, because no strategy works 100% of the time. You want to be mindful of higher time frame liquidity levels. Why is my tongue twisted? You want to be mindful of higher time frame liquidity levels, such as previous day's highs and previous day's lows. For example, if you are trading this opening range strategy and you are trading a move towards the upside, and you have the previous day's high above, price would generally use that as a magnet, and that would be most likely your resistance. So you want to be taking profits into that level. You don't want to be like, oh, I'm waiting for 1 to 2 and then it smacks back down and reverses. You want to be taking profit into that level. And if you see that maybe it's a 1 to 0.5 setup to that level, then maybe consider skipping the trade. It's not worth it. It could also be any higher time frame key level as well. So when you draw out your key levels, which may be your support and resistance on higher time frames, and you see that you're trading into a key resistance level and the risk to reward setup doesn't really make sense as your target, then you skip the trade. Same thing for the downside. If you're trading into a key level and you see that the risk to reward is 1 to 0.5, where you're risking $100 but you can only make 50, that's not sustainable. In rare cases, you can try 1 to 1, because this strategy has a high enough win rate, 60%, to be able to cover that outlier. So that's it for this video. Thank you so much for watching. If you watched to this point, I appreciate you, and I'll see you on the next one.